we are entering the third phase of the U.S. monetary policy regime. The first phase was characterized by a Fed that had to catch up to market expectations of tightening and ultimately sort of, accelerate that process to kind of get in line with market pricing, market expectations, et cetera. The second phase of monetary policy was the market moving ahead of the Fed again to say, hey, look, all this tightening that you're doing is going to cause a significant downturn in the economy. And eventually you're going to have to pivot. Initially, the pricing was sometime in the early part of next year to rate cuts and probably quantitative easing. Now I believe we're in this third phase of the monetary policy regime, whereby the Fed officials are talking out that speculative rate cut pricing from 2023 money markets, et cetera, because the Fed understands that in order for it to achieve its inflation objectives, they have to remain tighter for longer. And that's the new narrative around markets. It's tighter for longer. And what does that mean?
So basically, the market was like, oh, cool. You guys said you were going to tighten. You did it. You can't keep tightening too much. So like at some point, you're going to have to pivot. Because we're forward looking, let's go ahead and position ourselves for the pivot. And the Fed basically came out and was like, you guys are all nuts. We're going to keep doing what we're doing. Can they keep doing what they're doing though? Like they're saying it. Can they keep doing it?
I think this is the most important question of the day. The most important question of the longer term outlook for asset markets is whether or not the Fed will eventually start to acquiesce to more inflation pressure in the system by not sort of constantly fighting it and trying to get inflation back to their 2% target. The most important question of today, kind of the medium term, that's a more of a longer term view. The medium term is, can the economy handle it? And where is the neutral level of the policy rate? Go back to July, the FOMC meeting, where Jay Powell said effectively that, hey, look, we think we're finally towards right around neutral from the perspective of the policy rate, which at 2.5% is their estimate of long run neutral, which, if you ask any economists worth their shirt, obviously Larry Summers is kind of being the guy out front on this. 2.5 is not neutral in this new U.S. economy, whereby any measure you look at from a wealth effect perspective, stock market capitalization perspective, income inequality, the booming labor market, there's very clearly a lot of organic nominal growth potential in this U.S. economy. And so the key question is, will they break something? And at what level of interest rates will they break something? Clearly, they have not broken anything yet, as evidenced by this morning's JOLTS data and consumer confidence reports, gangbusters data.
So when we look at that whole idea of like, they're going to have to break something, people have been saying this for a while. You and I have talked about it a number of times this year. A lot of folks looking at their investment portfolio being like, it sure looks broke to me. Like this stuff is down a lot. What are you talking about when you say they have to break something? It's obviously not the investment asset kind of prices. It is these other data points. What do you expect to break? And they'll kind of be the canary in the coal mine that's like, okay, we're getting close to some sort of pivot.
Yeah, well, the question is, they've done a decent amount of damage to investment assets, but let's not forget the starting point was basically a bubble in the stock, bond, and cryptocurrency market. So, taking a little bit of air off taking a little steam off those bubbles doesn't necessarily mean that we've broken anything. Obviously, S&P right now, inclusive of today's decline, is still only down like 15 or 16% from its highs, from a very asymmetric all-time high, obviously. So it's not really saying it's broken anything. What I mean by breaking something specifically in the economy specifically is the labor market. This is a U.S. labor market we've talked about many times on the show that is growing at rates that are effectively double our pre-COVID trends. If you look at private payrolls growth, on the 3-month annualized basis, double average hourly earnings growth, double private aggregate private sector income, more than double the pre-COVID trend when you productize all those different features and factors. So this is the labor market, as evidenced by the JOLTS data that we just got today, accelerating another 200,000 to 11.3 million, or 11.2 million rather. This is a labor market that is growing so robustly that the Fed has a significant amount of work ahead of it still in order to kind of take some pressure out of the system.
Hey, you, did you like this video? Great. Make sure you subscribe, like the video, and see you next time.